Hey guys, on this installment of the RE Investor Academy, we're going to talk about why some people consider real estate the ideal investment. What does ideal mean? How does that make sense? Well, ideal is actually an acronym, and the I stands for income, the D stands for depreciation, E stands for equity, A stands for appreciation, and L stands for leverage. Now, in this brief discussion, we're going to talk about how it affects buy and hold real estate. We're not going to get into fixed flips or wholesaling. This is just for a buy and hold scenario here. So we'll talk about why it would be considered the ideal investment and what the acronym means. So first, the I stands for income. Income's pretty straightforward. So where's the income come from? This is your rents you get back from somebody, whether they're renting your property, renting your storage unit, your multifamily, your duplex. Basically, they pay you, and that's your income, is the difference between what you happen to owe on taxes, mortgages, anything that you owe on the property, and what you get to keep. So that way you get income, and that comes back to you really early, right as soon as you rent the property. So you want to rent the properties always as fast as possible. So what does the D stand for? D actually stands for depreciation. Now, if you're not aware of what depreciation means, depreciation is basically a tax term, right, on your federal income taxes. So if you don't have any real estate, what happens, you depreciate your real estate or any investments into the real estate over time. So this helps lower your tax liability. It's not a dollar for dollar amount. You can talk to your CPA, but basically they depreciate things over time. So that if you have a higher income, that helps bring your income down, maybe into a lower tax bracket. Maybe you just owe less in taxes at the end of the year. So depreciation is a really big thing that real estate investors love. Whether you currently are employed somewhere else and you're investing, or if you're investing full time, it always helps bring down your tax liability. That's one of my favorite things about real estate. So what does the E stand for? Well, the E stands for equity. And if you're not certain what equity is the difference between what you owe on a property and what the property is actually worth on the market. So for this example, well, let's say you have a $100,000 house, right? Let's say you only owe $80,000 on it, but you know it's worth $100,000. So now the equity in the property is $20,000. So equity is nice to have, but you have to remember you can't eat off of equity. That's why income is so important. So with the income, the money comes in, you can actually spend it. And for food, groceries, automobile, things like that, living expenses. But the equity is nice to have on your balance sheet because it helps build wealth. And the longer the balance is paid down, the more equity you get in the property. So that's what the E stands for, is equity. Then we come to A. A is appreciation. So what's appreciation? Well, real estate, it's an interesting conundrum because real estate appreciates over time, right? Over a longer period of time. But they allow you to do the depreciation like we talked about. So it kind of is against itself, but just remember the depreciation is just for income tax purposes when you're doing your taxes at the end of the year. Appreciation is, let's say that same $100,000 house we talked about, you buy it for $100,000, but let's say 10 years later, now it's worth $150,000. You didn't do anything different to the house. It's still the same house. You didn't make it bigger, right? You've just been renting it. So what happens is that house now has an extra $50,000 on top because things appreciate over time. Real estate appreciates over time. It's not like your car and it depreciates, then that money's kind of gone. So real estate actually appreciates. So we always look at appreciation as it's not guaranteed, but it typically happens. So we never buy a property saying, hey, I'll buy it now, it'll be worth $200,000 next year. We think of it as the cherry on top. It's just extra money that if you ever had to use it in the future, when we get to the next with leverage, that will help you have more leverage from the property. So the last thing in the equation is, acronym is L. L stands for leverage. So what's leverage? Well, when you have a property and it's paid down, or you have the equity we talked about before, sometimes you have enough that you can use that to get another loan or to maybe sell that property and leverage into another property, right? A bigger property, more properties. So sometimes you'll sell the property, other times you can keep it and just get a loan based upon the equity you have once it's paid down. and then you can move into another property. So that's what the L stands for. So today we went over why real estate is considered the ideal investment strategy. And we'll go over one more time. The acronym is IDEAL. I is for income, D is for depreciation, E is for equity, A is for appreciation, and L is for leverage. So that's the end of this episode. We're going to be putting out more content for you guys, some job site walks, kind of see some of the projects we work on. So down below, like, subscribe. We'd really appreciate it, so we know you guys are liking our content. And then as well, in the description, there'll be an email link. You can reach out to us if you have any questions, ideas for videos, let us know. So other than that, take care.